This week, there's likely to be a common themality throughout the central bank discussions. This week, we've got the Bank of Japan, of course. We've had the US interest rate decision and also the European Central Bank meeting. Next week, it's the Bank of England. But one of the big main themes is likely to be the amount of debt that's being accrued in an effort to contain the economic consequences of the COVID-19 pandemic. Our guest with us now to discuss this is Mark Oswald, Chief Economist and Global Strategist at ADM ISI. Mark, welcome. Extraordinary circumstances, I guess, require extraordinary solutions. There seems no end to the amount of noughts that are being put on the end of an already eye-watering debt pile that many economies have. What is the strategy here that central bankers are following?
Well, I think it's for once we've got a much quicker and much more coordinated effort on the fiscal and monetary policy front, which was inevitable because the situation requires rapid solutions. We don't need these sort of things being kicked around in Parliament or a long debate on any other monetary policy council. So the strategy is to ensure, I think on the central bank front, the important thing for them is to learn the lessons from 2008 and to make sure that we don't have the same sort of seizure in the financial system. We don't have the same sort of seizures in credit markets and asset markets in general. So the reaction has been quick. But the problematic, obviously, is that we accumulate a lot of debt at the same time. Bank balance sheets grow at an exponential rate, which we've not even seen previously. And the question is, what would be the exit strategy? I think for a lot of central bankers, the answer would be, well, let's not worry about the exit strategy for the moment. Let's try and make sure that things keep functioning rather than having a complete implosion economically and indeed of the financial system.
I think in one of your client notes this week, you talk about a debt trap. My understanding of a debt trap is that this is likely never to be repaid. Is this likely, do you think? Is there any sort of government policy that can be engineered around debt that's never repaid?
Certainly what everything looks like at the moment, as much as central bankers are at pains to deny it, this is what is called outright monetary financing, i.e. where central banks print money and buy government debt. Obviously, the worst example of that we've had, obviously, was the Weimar Republic in Germany with hyperinflation. I don't think that's necessarily the consequence at the moment. However, the problematic in the longer run is we've reduced rates, real interest rates down to zero. So we have no risk premiums in asset prices, and we don't have any term premiums, i.e. for taking longer dated risks. That leaves us in a situation where if you look at the last 10 years, 2010 to 2019, it cost, we basically had 50 trillion of new debt and 20 trillion in nominal GDP dollars of growth. So every $1 of debt of growth would cost us $2.50. And obviously, that's going to escalate much more rapidly this time. At some point, we have to recognize the fact that we are not going to grow our way out of all of this debt. And therefore, some form of debt jubilee, i.e. a write-down of this debt, is sort of seemingly inevitable. And it's pretty much the only escape route if we're not going to go down the route of taxing economies just when they're at the most vulnerable out of sight.
I think the model here, perhaps possibly maybe, can be taken more maybe from Rishi Sunak, the UK Chancellor of the Exchequer, just having written off 13 billion worth of debt for the National Health Service. This went down well in terms of column inches in the press. But I mean, realistically, is it possible to write down this sort of amount of debt consistently across all sectors within these economies? And what's the economic consequences of doing this?
I think this is a sort of basic problem all round. This is not just about the debt which is being accumulated and where one should write it off, but it's also in terms of the measures which are being taken at the moment to try and keep economies and the financial system going. It is a pretty wholesale spaghetti principle approach, i.e. you throw as much and you hope a lot of it sticks. unwinding it, and also at the same time realizing that there are a lot of companies which are going to be targeted, which are basically zombies. And as much as we want to keep those jobs going, as much as we need some sort of cleansing process, particularly as we go forward. We are going to see some quite dramatic changes to the way we work. We only have to think of, for instance, the way that consumers are going to think. We assume a big, rapid recovery, but that's predicated on private consumption restoring to previous values. I think consumers are going to be quite scarred. Businesses are going to be thinking about their supply chains. They're going to be thinking about these big offices that they've got and looking at the success that they've had in operating in lockdown. So, at some stage, we have to have a major rethink, because there are going to be actually quite a lot of things which end up as stranded assets, as well as those companies which weren't making any money beforehand and are now even more vulnerable. So it's going to be a very tricky process. It's not something which you can do. There is no big plan that anyone can devise. All one can do is come up with the best, what one manages in the best way possible in the first place, and adapt it as one goes along, because no plan is going to be perfect by any manner of means.
Just turning the conversation back to central banks. As I said, big week this week, got Bank of England next week, of course. What about interest rates? What about the longer term picture for interest rates? We're hearing a lot about the fact that rates are likely to stay low for longer, but what does all this do to inflation, this amount of debt? What's it do to the inflation outlook? And is inflation going to be the sort of the leading indicator that central banks will follow to give a steer to interest rates?
I think they certainly will be looking at inflation, but I think in the first instance, certainly for the next year, they're going to be far more focused on jobs and on growth. We're not going to see the sort of bounce back on a sustained basis. This is the issue here. It's not whether we have a knee-jerk rebound in, say, Q3, as seems to be the consensus. And I think I'll probably go with that. It's whether that rebound is then sustained, so we're operating at the sort of levels that we were beforehand. And the problematic that central banks face is basically we're unlikely to be able to be in a position to raise interest rates. They will be looking at inflation very closely. I think the inflation aspect which they need to look at most closely is how supply chain changes, i.e. disruptions, drive those prices higher. Because if we have higher production costs because we've shortened our supply chains and we have higher cost workforces, that will drive up inflation. We're also likely to see less availability if we're not sourcing everything from China. Clearly, that's a process which has been working process for quite some time. My concern primarily in the first instance is actually how they wind back all these measures which they are currently deploying or pumping in liquidity to markets. And when they think things are better, whether that's just going to create a shock of it and on its own.
Okay, look, well, Mark, we'll leave it there, but thanks for joining us. It's Mark Holst, while they're on the line from ADM ISI.